I think he's basically right. I wasn't particularly worried about the flattening yield curve. I'm not, hugely comforted by the steepening of the yield curve, but this is a move in the direction of normal. And the only justification for the high valuation of stocks has been the really low interest rates. Now that we're coming off that, you're going to see a lower valuation of stocks. So I think a lot of this is an economy moving towards normal. I'm not overly nervous.
So there's a lot of talk about the president's criticism of the Federal Reserve and moving too fast on high interest rates. Do you think that will have any sort of psychological effect on the Fed and its tightening policy?
There's no question the president's criticism was completely off base, completely stupid. But I think he's gotten himself to a place where he's just completely ignored. He has a set of Fed picks, some of whom, like Marvin Goodfriend, are quite hawkish. At the same time, he's telling the Fed to be dovish. He says one thing about exchange rates. He says his policies move exchange rates in another direction. So I think he's just ignored at this point. That's a bit of a shame, but I don't even know how much of a negative it is.
Jason, if you're Powell, what do you do if you decide in December that it's time to pause for legitimate reasons? How do you do that without looking weak?
I don't think the Fed should be targeting the market. It should be targeting inflation and employment. But the market affects inflation and employment. Over the last week, financial conditions, the change in them, is equivalent to about 1/4 point hike. If you look stock market off 5%, yields up about 10 basis points. That's the equivalent of one Fed rate hike. So I do think if things are still in a place like this, they should say they're data dependent, that financial conditions have tightened, that's moving us in the direction they wanted, and continue taking a break in December. I think that would be a welcome thing for them to prove their data dependence in that way.
Jason, Jamie Dimon, the chairman and CEO of JP Morgan, which reported its third quarter results this morning, chose to include in their press release, right at the top, what appear to be increasing concerns about increasing economic and geopolitical uncertainties, which he says at some point in the future may have negative effects on the economy. Do you agree?
I think geopolitical uncertainty is only a downside risk right now. And how we're going to get out of and resolve this situation with China right now is, to me, not something I can see to the end of, and something that could get a lot worse before it gets better.
Do you expect it's going to get worse before it gets better?
I think so. We have the tariffs ratcheting up again at the beginning of next year, and we're making a set of demands of them that I just don't think China can meet. We were willing to take yes for an answer with Mexico, with Canada. Would we be willing to take yes for an answer from China? I'm much less sure of that.
Do you think the U.S. economy is slowing, Jason, from these super fast levels that we've seen on GDP in the last few quarters?
I think it is. We've seen, of course it is. I mean, you're not going to have 4% growth every quarter going forward. We had a lot of fiscal stimulus this year. We're going to have a little bit more injected into the system next year. Then it'll start coming out. Our trend growth rate is still, 1.5% to 2%. And, our employment can't keep improving forever. We're going to start heading towards that trend. Again, I don't think that's a huge worry, but anyone counting on a continuation of what we've seen lately, I think would be foolish.